Good evening, guys. So you're welcome to another class for, corporate reporting. And I hope you had a wonderful day. So our plan for tonight is for us to finish up on IFRS 2 on share-based payments, and for us to start IAS 19 on employee benefits. So for the past two classes, we have been trying to explain the principles behind employee benefits, behind share-based payment to you. And today, we're going to wrap it up. And I hope you still remember the core principle, whether it's equity settled or cash settled. That the core principle is just for us to ensure that we recognize that expense, that share-based payment over the period of vesting, over the vesting period. You don't wait until the option or the right vests before you recognize it in the books. You recognize it over the vesting period. And for equity settled share-based payments, we saw that such is usually granted by the employer to either giving shares or share options. And when it is a transaction between the employer and the employee, this share-based payment, this equity settled share-based payment, we saw that it is usually measured at fair value of the option at the grant date, quote and unquote grant date. So it's measured at the grant date. Additionally, we learned that at the end of every year, you need to estimate the number of employees that will vest. When I say that will vest, we are talking about at the vesting date. So we will need to make an estimate of the number that will remain with the company at the vesting date. So it took some of us time to understand that, and I hope you have revised and now you are at home with that principle. And for equity settled share-based payment, when you want to recognize it in your books, you simply debit staff costs if it's a transaction with employees, and you credit equity reserves. And for cash settled, which was the question we ended with, solve the question on cash settled. And for cash settled, that is usually measured using the fair value of the rights or the option at each reporting date. So it is measured at each reporting date. And when you have a cash settled share-based payment, what the employer will issue is either a share acquisition right or a redeemable shares. That's what the employer will issue, because the cash settled involves giving cash based on the price of the entity's shares. Furthermore, when you want to recognize cash settled in your books, we will usually debit staff costs and credit liability. Now, today, I want to quickly solve two questions first. Questions that would show a scenario. I have explained this principle to you before, but I will just solve question on it today very quickly, which is a scenario where there is a modification. And a modification is usually a situation where we have the share price of the company falling its share price is falling, resulting in a situation where the company will have to reduce their exercise price. They will have to reduce it. And this is because when we enter into a share-based payment transaction with our employee, especially equity settled, modification is only applicable to equity settled. So especially equity settled, the promise we have made to our employees is that when you work hard for us at the vesting date, you can buy our shares at a very low price, which we call exercise price. So this exercise price is something they will have agreed right from the inception of that agreement. So we are saying that if you have a scenario whereby the company's share price start falling, I mean, I've set an exercise price of, let's say, 5 naira. The company share price now start falling, is now getting close to that 5 naira. That means the entire share option does not make sense to the employees anymore, since the company share price. So instead of doing this share option with the company, they can just easily go and buy the company's shares on the market. So what makes it attractive is that the exercise price must always be reasonably lower than the share price. So the scenario we want to deal with here is that if the share price starts falling, then it's expected that the company should also react. They need to reprice that exercise price by reducing it so that it's still attractive. So when they do that, it has an effect. And the effect is that, you see, when they reduce that exercise price, it is going to increase the value of that option. That option becomes attractive again. By so doing, the fair value of the share option will increase. The fair value of the option will increase. And this is the only part that will affect our calculation we have been doing so far. Remember, when we were dealing with equity settled, we usually measure those options at the fair value of the option. So when fair value of option increase because the company has reduced the exercise price, that means our calculation will be impacted one way or the other, at least from the date of that repricing till the vesting date. So that is the principle behind modification. So again, the share price is falling. The company then has to reduce the exercise price. And immediately they reduce the exercise price, it's expected that the value of the option will go up. It becomes more attractive. So the fair value of the share option will also increase. And in most cases, or in all cases, it will increase in the same proportion as the decrease in the exercise price. Okay, so let's solve a question to see how that will impact our calculations. So look at this question. We said Delta prepares financial statements to 31st December each year. It now said on 1st January 2002, Delta granted 500 share options each to 10 senior executives. The option vests on 31st December 2005, provided the relevant executives remain in employment and provide services to Delta until that date. On 4th January 2002, Delta estimated that all 10 executives would remain in employment for the 4-year period. and so be entitled to exercise the options. This estimate was confirmed on 31st December 2002 and 31st December 2003. The fair value of the option on 4th January 2002 was 2 naira 20 kobo. We're now told that during the early months of 2003, the share price of Delta fell significantly, and on 30th June 2003, Delta repriced the option, the option package by using the exercise price from 4 naira to 3 naira 40 kobo per option. This caused the fair value of the option at 30th June 2003 to increase by 60 kobo. So we are now asked that how would this be accounted for? Okay. Now, looking at this, so the year end of this guy is December. 1st of January 2002 is the grant date. There are 10 employees. We are giving each of them 500 options. So they will vest on December 2005. That means the vesting period should be 2, 3, 4, 5. That's 4 years. That's 4 years, provided the relevant executives remain in employment and provide services to Delta until that date, of course. We're now told that on 4 January 2002, Delta estimated that all 10 executives will remain in employment for 4 years. So they are making estimates of vesting at the beginning of the year. So this estimate is not going to work for us because the standard says that we should make estimate of the number of employees that we vest at the end of each reporting period. So this beginning of the period, we can't rely on it. So they now went ahead and said that this estimate was confirmed at the end of the year, 2002 and 2003. Okay, then we can rely on it now. Now we can rely on it. Since they say that this estimate that all the 10 employees will remain in employment to the vesting date, that means, and they told us that now it is confirmed at the end of the year. So that means they are making that estimate at the end of the first year and at the end of this, at the end of the second year. So now it can work for us. We're now given the fair value of the option at the beginning of the year, which is at the grant date, which is 20 kobo. So that's the first part of the question. Now, the second part is that in 2003, share price of the company fell significantly. So the company revised the option package by reducing the exercise price from 4 naira, 3 naira 40. So because the share price is falling, they had to reduce the exercise price by 60 kobo. Look at this next paragraph now. They now said this caused the fair value of the option at 2003 to also increase by 60 kobo. So the fair value of the option also increased by 60 kobo. And I told you that the proportion with which the exercise price is reduced will be the same proportion with which the value of the option will increase, which is this. So the only impact on our workings from 2003, from June 2003, is the fact that this fair value of the option has increased. It was 2.2 before. Now it is 2.8. So let's see how we deal with that. Now, similar to what we have been doing, let me just break it down for you. In 2002 now, what's the value of this option? We have 500 options, right? We have 500 options. We have 500 options. And the estimate of vesting was that all the executives will vest. And they had confirmed that at the end of the first year. So that means the estimate is 10. Everybody will vest. And this is the fair value of the option, 2.2 naira. How much would that give us if you press your calculator? 500 times 10 times 2.2. That's 11,000. Are we going to recognize this entire 11,000 in our books? No. We divide it by 2. So what we recognize? No. We'll divide it by what? Can't divide it by 2. We'll divide it by the vesting period. So since it's going to vest on 31st December 2005, and it's starting from January 2002, so we divide it by 4, 2, 3, 4, 5. What does that give us? That's 2,750. So what's the double entry for this 2,750? We debit staff costs, we credit equity reserve with this 2,750. In 2003, what are we going to have in 2003? So they confirmed that estimate in 2003 as well, meaning that it's 10, the whole of the 10 will remain. So in 2003, it's still going to be the same, 5 times 10 times 2.2. So this will now be 11,000. Now is multiplied by 2 over 4. Then that will be 5,500. So this 5,500 will go to reserve. It's going to go to reserve, while the increase will go to staff costs. That means our staff cost is going to be this 5,500 minus 2,750. And that will still be 2,750. So this question did not give us estimate for 2004. So that means they don't even want you to do 2004. However, in 2003, there was a decrease in share price resulting in an increase in exercise price. But the main thing is that our fair value of the option increased. This 2.2 naira, it increased by 60 kobo in 2003. Now, how do we deal with that? The standard says that for that increment in the fair value of the share option, 2003, just deal with that increment separately. Don't mix it with the original share option valuation. Deal with that 60 kobo separately in such a way that you are going to calculate additional expense in 2003, additional value, which is that 500 options times 10 employees. Now you're going to use times 60 kobo. You are doing it separately. Okay? So if you do this, what do we get? That's 3,000. So this 3,000 now, how much are we going to recognize in 2003? How much do you think we should recognize in 2003? Is there anybody that can try this one? How much are we going to recognize in 2003? Anybody? Who wants to try?
Is it the increment, the 250?
No. No. I don't even know which 250 you're talking about.
You know, for 2003, we recorded 2750. And when we had the increment of the share price, we had 3,000. So your question is, what are we going to recognize? And I'm saying 3,000 minus 2750. That will give us 250.
No. Ah, this class, you people are peculiar in this classroom. I don't know. I'm not enjoying teaching you people. You don't talk. You don't participate. You don't even know whether you are getting or not. You just be there. So this increment happened in 2003, and the vesting date is 2005. So this increment will be treated from June 2003, when the increment happened, till December 2005, which is the vesting date. So since we are dealing with the increments separately, so the increment started from June 2003, where there was increase in the fair value of the option. So this 3,000, we are going to spread it over from June 2003 to December 2005. Just like this original one now, we're spreading it over 4 years, right? This one, we're going to spread this one over, and June 2003 to December 2005, that is 2.5 years. So, and 2.5 years is synonymous to 30 months. So for 2003, since it's from June, then that will be 6 months. So we'll have 6/30. That's what 2003 will get. So 6/30 times 3,000, that will give us 600. So the 600 will recognize as staff costs, while the other leg will go to equity reserve. In the next year, which is 2004, for the increment, I just want to continue. I can just stop here because this question didn't really want us to continue to 2004, since they didn't give us estimates in 2004. But just for me to explain how you spread this 3,000 over. So let's assume it's still the 10 employee that will vest at the vesting date. So it's still 500 times 10 times the increase is still that 3,000. So in year two now, it will now be 18/30 to give us 1/2. So just like the way we have been doing the one we were doing before, when we're spreading over 4 years. So in year one is times 1/4. In year two is times 2/4. In year three times 3/4, like the previous question we solved. For the increment, now in year one, it was just 6 months that was in year one. So 6 months/30. In year two, will be the cumulative, which is 6 months in year one and 18 months and 12 months in year two. So that's 18/30. That means in year three will be 30/30. So now, is this 1,200 will go to equity reserve? Why the increase in reserve between 1,200 and 600 will go to your P&L as staff cost? So in year two now, what goes as staff cost to P&L is just the cumulative minus the increment. That's 600. Take it to, is this 1,200? This should be 1,800. So 1,800 minus 600, that gives us 1,200, like that. Okay, so now if somebody asks us that, okay, in year three or in 2003, how much did you recognize to P&L for staff cost in 2003? That would just be 2,750 from the original valuation plus 600 as a result of the increment. So it's like recognize a total of around 3,000 plus to P&L. So that's modification. It's really nothing different from the other ones we have done, other than the fact that there is an increase in the fair value of the option. And for that reason, we need to calculate like increment, like additional valuation that we are going to spread over the remaining period. Just like for this 60 kobo, I did not mix it up because our alternative way of doing it is just to remeasure this 2003 and say it should now be 2.8. But there will be a lot of complexity, calculations and all of that. That's why we did it separately. So the 3,000, I'm spreading it over 30 months, over 2.5 years. We did for year one, so I can continue like that. But this question really want us to stop in year three or in 2003. Okay, so that is modification. Now, still under equity settled, there is what we call cancellation. So for cancellation, the employer is saying, I don't want to be involved with this share-based payment transaction anymore. I don't want to give shares to anyone anymore at vesting date. I want to cancel this agreement. So which is okay. The employer can cancel. Just that when the employer cancels, it's going to result in the employer having to settle or compensate those employees. You have to compensate. That means that share-based payment or that equity settled share-based payment will vest immediately. So if the value of the entire option at the date when it canceled, we need to get the value at the date when it canceled. That means that value, instead of it vesting in the future as agreed, but since the employer says he's not doing anymore, he wants to cancel, that means he must be ready to pay that money, that vesting amount. He must be ready to pay it immediately. And that's what we call acceleration of vesting. So cancellation will usually be treated as an acceleration of vesting. So that means we are going to recognize all the amounts at the date of cancellation. Any cost related to that share-based payment transaction will be recognized immediately. Now, when we get that amount, then we can then know how much do we want to compensate those employees, and he has to compensate them. And usually the compensation will even be higher than the value of that option. In a rational situation, it should not be lower because it's the employer that says he wants to cancel. So, and if he's canceling, he should be ready to bear the cost. Now, let's look at this scenario. This talks about Epsilon prepares financial statement to 30th June each year. We're now told that on 1st July 2002, Epsilon granted 200 options to 50 employees. So that means this 1st July is the grant date. Is the grant date. So we are giving 200 options to 50 employees. We now say the options vest on 30th June 2005, provided the employee remain in employment with Epsilon until that date. That means the vesting period is how many years? June 2003, June 2004, June 2005. That's 3 years. We're now told that the fair value of the option on 1st July 2002 was 2 naira 50 kobo. That's the fair value of the option at the grant date, which we use for our valuation. We're now told that at the end of the first year, which is June 2003, since the beginning is July 2002, that means the end is June 2003. It was estimated that 48 employees would remain in employment until 30th June 2005. So they are estimating that 48 are the ones that will vest. So estimate of vesting is 48. We're not told that on 1st January 2004, Epsilon canceled the option package. At that date, all 50 employees who were granted the option were still in employment. Epsilon made a compensation payment to the affected employees of 2 naira 70 per option, which was the fair value of the option package on 1st January 2004. How would this transaction be accounted for? Okay, so firstly, at the end of the first year, nothing has happened because the cancellation started in the second year, in the middle of the second year. So let's get the value. Let's do our usual calculation. So at the end of the first year, which is June 2003, we are going to debit staff costs, credit equity with 8,000, which is 48 employees multiplied by 200 options, multiplied by the fair value of the options at grant dates, then multiplied by 1/3. That gives 8,000 for year one. But as at the end of year two, before then, there was a cancellation on January 2004. You see, as soon as we cancel, it's going to accelerate vesting. So what's going to happen is that in that January 2004, we will say, okay, how many employees were available? They told us that all 50 employees were still in employment at the day they canceled. So we'll say, okay, what's the value of this whole share option as at today? So all 50 employees were there. Each of them, we are giving them 200 options. And we value this, each option at 2 naira 50 kobo, which is the fair value of the option at the grant date. 2 naira 50 kobo. So that will give us around 25,000. So this is the value of the option. So don't forget, this 25,000 is what will show in our reserve, the cumulative, the value today. But what shows in P&L as staff costs immediately will be the difference between the cumulative 25,000 minus what we recognize in year one in reserve, which is 8,000. So that means what we recognize in P&L this year will be 17,000. But ultimately, the key message is that it is vesting immediately. Since we are canceling, it's vesting. Now, so what we need to pay the employees is 25,000. And we have recognized what we need to recognize to staff cost, which is the increments, 17,000 to P&L. Now, the employer now say, okay, I'll pay compensation, but I'm going to pay 2 naira 70 kobo per option. So how much does that lead to? So that compensation payment, let's calculate it. How much is the compensation payment? Knowing fully well that we have 50 employees, each of them gets 200 options. And this guy says he's doing 270 kobo per option. If you punch a calculator, that will give us 27,000. You will see that the guy is now paying more than the value of this option. So we need to clean off this reserve from our books. How do we do that? Reserve is a credit balance. So we need to debit equity reserve with 25,000. We are going to pay money. We'll pay those staffs. We are paying them 27,000. We are paying them 27,000. So debit and credit is not jiving. There's still a balance on the debits of 2,000. Who can tell me where we will take this 2,000 to? Let me not stress myself. I know you will not talk. We'll take it to POL as an additional expense because we're supposed to settle 25,000 and we are settling with 27. There's an additional cost of 2,000 naira. So while we cancel out this reserve, this 25,000 option that we have accumulated in reserve, that okay, this is what we need to pay these guys, and we have agreed to pay them 27,000 more than. So that means there's an additional cost for us that we're going to debit to P&L as staff cost. Okay, so that is cancellation. Is a result in acceleration of vesting at the date of cancellation, meaning that we're going to get the entire value. So there is no need for proration anymore because that becomes the vesting date. So with that value, we will then need to settle our employees. This guy now is settling higher, so resulting in an additional cost. That means if the calculation of what is settling, let's say it's 23 or 22,000, that means settling for lower. That goes to show that that reduction will be an income to him. That will be an income to him. Okay. Now, the last part that I've not really touched is the third type of share-based payment transaction, where there is a choice of settlement. The one whereby the employer is not sure. I mean, the choice of settlement is between the employer or the counterparty. They have a choice on how that transaction will be settled. Okay, either it should be settled with cash, that is cash settled, or it should be settled with shares, with shares, that is equity settled. So in this case now, we'll have a situation whereby the employer is not sure whether he's going to settle with cash or whether it's going to settle with shares. He's not sure. So I'll have that kind of scenario. IFRS 2 says that we are going to treat that as a compound financial instrument. We are going to treat it as a compound financial instrument, meaning that since we are not sure whether we'll settle with shares or with cash, so that means we need to consider elements of the two. Okay, in our books, at the date we are putting it in our books, we need to consider elements of the two. So the key question then becomes, what will be the split? If you are considering, because there will be a value that you are expected to pay, there will be a valuation. So how would you split the one that is equity settled and the one that is cash settled? To do the split is very straightforward. The standard says we should apply our knowledge of conceptual framework that states that equity is a residual interest in the asset of an entity after deducting all liabilities. So that means we would need to get the value of the cash settled first, which is a liability. Then whatever is the balance, whatever is the residual, will now be equity. That's how you're going to split it. You will get the value of the debt first. Whatever is the balance, we are going to treat that as equity. So as soon as you're able to split, then at the end of each year, you then apply the knowledge that you already have. So the one that is debt, which is cash settled, you'll be measuring it at the end of every year based on the fair value of the shares or the rights at that year end. While the one that is equity settled, we're going to measure that based on the fair value of the option at the grant date, meaning that value will not change. It will not change, at least provided that no employees is leaving, that the estimate is that everybody will vest. The equity settled will not change because it's measured at the fair value of the option at the grant date. So just what we have been doing before. So the only addition here, when there's a choice of settlement, is that at the date of the transaction, we will need to split that value into equity and debt. That's the first thing that needs to be done. Okay, so let's look at this question to attain that. So we have that Omega prepares financial statements to 31st December each year. We're now told that on 4 January 2003, Omega offers an executive the right to receive on December 2004 either a cash payment equal to the value at 31st December 2004 or 5,000 shares or 6,000 shares. A condition of the issue is that these shares cannot be sold by the executive before 31st December 2006. So this is what I'm saying. So at the grant date, this Omega is offering the staff, its executive, the right to receive either of these two. Okay, either they get cash based on the value of 5,000 shares. Okay, based on the value of their shares, which is cash settled, or they get shares, which of course a condition is attached to it. And when a condition is attached to shares, it becomes a share option. So, or they get share option of 6,000, which is equity settled. So this is what we are saying. So we are giving a choice of settlement. At this point, we don't know which one the executive will choose. We don't know. So we have to consider element of the two. So I'll show you how to do that. But let's finish reading the question. We're not told that the rights will only vest if the executive remains employed by Omega and provides service in the 2-year period from 4 January 2003 to 31st December 2004. The executive is expected to remain in employment and so become unconditionally entitled to the rights. Share price movement for Omega over the 2-year period are as follows. So they give us some share price movements. When I told that the fair value of the share alternative is estimated at ₦9 each, an option pricing model is used to arrive at this estimate. You will not be able to complete it. Okay, so now this fair value they give us is the fair value of these 6,000 shares, the fair value of the share alternative. That's the ₦9. That's the fair value of the share alternative. So how do we account for this? So now, they gave us a lot of information, but the first thing we need to decipher is at the grant date, we need to split the value of the shares, okay? The value of what we are offering, which ultimately is 6,000 shares, though there's an alternative, which is collecting cash based on the value of 5,000 shares. But the underlying instrument we are giving is 6,000 shares. So we need to know what's the value of that. That value is what we will now split into debt, which is for the cash settled, and the balance being equity. So let's do that. Now, the first thing is that the value of the shares, or what we are granting is 6,000 shares, and they told us that the fair value of this share alternative is ₦9. So multiply by ₦9, and that gives me 54,000. This 54,000, we'll then split it into debt first. We need to get the debt component first, then the back become equity. So the debt component, which is the one that is cash settled, that is, we said get cash equivalent to the value of 5,000 shares. And don't forget, we are doing this at the beginning, at the grant date. We need to do this split at the beginning of 2003. So the debt component is the value of 5,000 shares, which is 5,000 shares multiplied by the value at 2003, which is when we are doing this calculation, and that's ₦10. So if we multiply by that ₦10, that will give us 50,000. So out of these 54,000, the debt component is 50,000. That means the equity component is the balance, which is 4,000. That is 54,000 minus 50,000, which is 4,000. Now, at the end of the year, since 31st December 2003, the one that is equity component, we have already established that the total value is 4,000, but we cannot recognize everything in year one, since the vesting period is 2004. The vesting date is 2004. That means the vesting period is 2 years, 2003, 2004. So this one, we're going to recognize it over 2 years. 2,000 in year one to staff cost, 2,000 in year two to staff cost. But this is year one, 2003. The one that is debt components, or let me call this equity settled. The one that is equity settled, we'll recognize 2,000 in each year. The one that is cash settled, which is the liability or the debt component part, that one is measured at the end of each year. If you remember how we did cash settled, if we had revised, we measure it at based on the fair value of the shares at the end of each year. So that means, again, at the end of the first year, we will get our 5,000 shares multiplied by the share price at the end of year one, which is 11. And that gives me 55,000. This 55,000, we'll recognize it over 2 years. That means in year one, we'll have 1/2. So what does that give us? That should be around 27,250 or 500. So 27,500. 2004, which is the second year, the equity settled, we recognize still the value is 4,000 to change. We'll still recognize 2,000 again. But the one that is cash settled, which is the debt, the value will change. We will remeasure it again. That 5,000 shares, it will be measured at the share price at the end of 2004, which is 12 naira. And that gives me 60,000. So in year two, what would be in our reserve or what would be our liability would be this 60,000, because don't forget it will be 2/2. The same thing as this one, this equity settled. It's 4,000 that will be in reserve. It's 2,000 that will go to staff costs. So here now, 60,000 is what will be as liability. What will come in as staff costs will be the increment, just like we have been doing, which is 60,000 minus what was recognized in year one, which is 27,500. And that gives us how much?
We can't hear you. Oh, I can't hear you. I think you're muted.
Oh, okay. I was muted. So the only difference is that while the value here that we got, the value of this instrument at the beginning of the year, we'll need to split it because we are not sure what the counterparty is going to go for. So we splitted it into the one that is cash settled and the one that is equity settled. Then at the end of each year, it's the same principle as we have learned. For equity settled, we just spread it over 2 years, 2,000 in year one, 2,000 in year two. For the cash settled, that one, the value will be changing based on the share price at the end of each year. So in year one, 11 naira. So we prorated that. In year two is 12 naira. So while 60,000 goes to liability, is the increment that will go to staff costs. Is the increment that will go to staff costs. Okay, and the explanation is here, and of course, the workings is in your note also. Now, deferred tax implication of share-based payment. I'm going to leave this one until when you're taught, when we have done income tax. When they teach you deferred tax, then we'll come back to this one. So, and so that it will flow very well. Otherwise, I'll have to be teaching deferred tax over. So let's just put this one on hold until when we learn that. Okay. In this our note, I did a summary. I did a diagrammatic representation of everything so that you can use this to revise the entire principles that we have. Now we have some practice questions here. And of course, I've put solution there for you. So what you will need to do, very importantly, is for you to go through these practice questions to see that you're able to solve it and understand it. If there's any area you don't understand, you can let me know. There are plenty of questions there that you can practice. There's even ICAN pass question. Like this one is an ICAN pass questions. You can try it. There is ACC question there. Let me see. Yeah, you can try this, but you might not be able to do the one of different types since we are leaving that to when we have done different types. But you can look at the others. And there is also a question on diploma in IFR from Deep IFR. You should be able to solve that because it's what we have actually revised. So just try it and see how far you can go with them. They will really help you. So for me, I have covered very well this topic that if you understand everything I've been saying from the beginning to the end, I strongly believe that whatever question they want to ask you, you should be able to tackle it in the exam. So the only one is just the deferred tax. Now, let's move to another standard, which is IAS 19 on employee benefits. So this one I'm going to start today. And then we're going to finish up next week. So IAS 19. So what's IAS 19 talking about? IAS 19, which is employee benefits, is very similar to IFRS 2 because both of them are employee compensation. Both of them are employee. In fact, IFRS 2 used to be within IAS 19. Just that they just had to separate it because it requires its own separate standard. So they removed IFRS 2 from IAS 19 so that it can be a standalone standard. So the first thing you need to understand here is what is an employee benefit? And from the name employee benefits, it refers to all form of consideration that is given by an employer to an employee for the services the employee rendered to the employer. So is any form of consideration. But don't forget, when I say any form of consideration, except shares, if the consideration is in form of shares or share option or share acquisition rights, that means it's not going to be treated in IAS 19. It will be treated in IFRS 2. So employee benefit is all form of consideration. That means that the focus of this standard, what we want to learn in this standard is, okay, how do we treat this consideration, this money we pay to our employees, whether cash or non-cash, how is it treated? That is what IAS 19 is all about. Now, having understood that employee benefit is all form of consideration given by an employer to an employee, then we need to quickly understand what are the employee benefits that we can have, since that is what we want to account for. What are these employee benefits? So there are 4 employee benefits that we can have. We have short-term employee benefits. We have post-employment benefits. We have other long-term benefits. And we have termination benefits. These are the categories of employee benefits we need to learn how to deal with for this standard. As soon as we are able to do this, then we are good to go. So let me gloss over these four. Then we pick them one by one. The first one, which is short-term benefits. Short-term benefits. You see, this short-term benefit is any form of consideration that is given to an employee within 12 months. That's short-term benefits. And those are the popular wages and salaries and the allowances. Any benefits that we give to our employee within 12 months. That will fly as short-term benefits. Then the post-employment benefits. These are benefits we'll give to employee at retirement. So when the employee retires, we will need to give them benefits. So that benefit we'll give to our employees when they retire, those ones are post-employment. Okay, there are benefits at retirement or there are benefits at the completion of employment. Post-employment benefit. And there is the other long-term benefits, which are the consideration or the benefits we'll give to employees after 1 year. After 1 year. And a popular one is this long-term service award. Or we give our employees car or house when they have worked with us for more than 1 year. So those are other long-term. They are benefits we give to employees after 1 year. Then there is termination benefits. These are benefits we give to employees when they are fired, when they leave our employment. So usually when the employer asks them to go, or it might be themselves that they say they are not working again. Either way, the point is that there was a termination. So if there is any benefit around that, that benefit will be termination benefit, like the one that's happening with CBN and its staffs, where CBN told some staff to stop working. So, and they said they will give them certain billion. That money they want to give them is termination benefit, because it's not like they retire. They ask them to go. And because of that, they say they want to compensate them. Okay. For these post-employment benefits, a typical example that you all know will be pension and gratuities, but we'll get to the core. But I need to tell you in advance that the focus will be on short-term and post-employment. That's the one that has a lot of effort to account for. And that's what is really popular and a little technical. So that's one you'll find in your exam. I've never really seen ICAN asking this one in a long time. This other long-term and termination. I've never really seen them ask it, but not that they can't ask it. Of course they can. We have not really seen them ask it. Okay, so but we would touch on them very briefly. So let me start with this short-term employee benefits. So please, let's pay attention. So how do we recognize and measure short-term employee benefits. That is, how do you account for it? Very straightforward. You see, for short-term benefits, in this part of the world, in Nigeria, the popular one is salaries. And salaries are paid every month, monthly. But, that is not how it is in some other part of the world. It could be daily. It could be daily, it could be weekly, anytime. But the key question for us is that when does the employer has an obligation to pay this benefit? When does the employer has an obligation? And he has an obligation when the employee starts working. So as soon as the employee has worked for you, you have an obligation. So whether you have paid it or not is not even the question here. The question is, as the employee worked, as soon as the employee has offered the service, you have to pay. Meaning you have a liability that you cannot avoid. So in this part of the world where we pay monthly, that means at the end of every month or at the due date of payment, when the employee will have worked and made effort, you need to recognize these short-term benefits, usually wages and salaries, by debiting staff costs, and usually we can credit accrued staff costs at the end of every month. So let's assume that what we owe, what we are supposed to pay, let's assume is 50,000. So maybe after a week or thereabout, we now settled. We paid this 50,000. You know that ordinarily, this one will have gone to POL. While this one will have gone to statement of financial position under current liabilities. So when we now pay, when we settle the obligation, how do you then deal with that? All you just need to do is this liability will be netted off. It will be cancelled when we settle. So we simply debit the accrued staff costs and we credit bank since we are paying. It's possible also to overpay or pay in advance. There's even nothing like overpay. It's paying in advance. Meaning that instead of paying, let's say the salary you're supposed to pay is 50,000. We now paid 100,000, like 1 month advance. How do we deal with that? Instead of paying 50K, we paid 100. That means by the time you are crediting accrued staff costs, you're debiting it with your 50,000. How much you were owing. And you are crediting bank what you actually paid. Let's say you paid 100K, but you paid 1 month in advance. That means there will be a debit to what we call prepayment of 50K. There will be a prepayment. So if ICAN is going to ask you this, is around understanding that if you are owing, that will be an accrual. If you pay in advance or you overpay, that would be a prepayment. Okay, and this prepayment would come under current assets. It will show under current assets. Now, that's short-term benefits. However, under short-term benefits, there are some payments called short-term paid absences. Paid absences. That is, we are paying our staff even though they did not work. You did not work, but we are still paying you. That's short-term paid absences. And a typical example is our annual leave. Our annual leave. That's a typical example of it. So now, the deal here is this. Accounting for it should not be difficult at all, because we should have just accounted for it every month as part of staff costs. But we need to understand the policy of the company, because there are some organizations that will say that if you don't take your leave this year, it's gone. It's gone. You cannot take it again if you don't take your leave this year. While there are some that will say that, okay, if you don't take it this year, you can take it next year. You can take it next year. So the standard calls organizations whose policy is that if you don't take your leave this year, it's gone. They say those ones, they are operating a non-accumulating paid absence scheme. While the one that if you don't take it this year, you can carry it forward, those ones are accumulating paid absence. So accounting for them is quite different. You see, the one for the non-accumulating, this one, non-accumulating paid absence. You see, this one, we are saying that if you don't take your leave this year, it's gone. Then how do you then account for a scenario like that? So, like I mentioned earlier, the key thing is, okay, at what point do we owe as an organization? At what point do we have an obligation for this type of scenario where we are telling the employee that if you don't take it, you won't get paid? It means that we only have an obligation when the employee takes the leave. When the employee takes the leave. Or I can say when the event occurs. That is when we can recognize it in our books. So when the employee takes leave, then we recognize it. That means if he doesn't take the leave, it will not even pass our books. If that's your policy, you don't need to recognize the leave at all. It's only when they take that leave that you can then debit staff costs and credit accrued staff costs. When they take the leave, they don't take it, they don't get paid. So that means we don't have an obligation until they take it. So when we then pay, then we credit bank, we debit the accrued staff costs. The next one, which is accumulating paid absences. You see, for this one, we are saying that even if you don't take the leave this year, we will pay you. Not that we'll pay you this year, next year. You can take it next year. In that case, that means we have an obligation because we will still have to pay. We will still have to pay. But listen to me carefully. You see, the amount you are paying now is now based on what the employee will actually take. Because usually, what will happen is that most companies will say that if you don't take your leave this year, yes, you can take it next year, but you cannot take everything. No. You can only take half. Or you can only take, they would reduce it. And the employee might not even take at all. So we would expect to then make an estimate at the end of the year that, okay, what will be our additional costs? So for accumulating paid absences, it is recognized at the end of the year where we can have clarity. That is, if people don't take their leave, those that have taken that will have paid, will have recognized that one. Right? Now, the concern are those that have not taken. So how should we put it in our books? Because they will still take, or they might still take, because they can carry it forward. So we are not saying how much are you going to recognize. The standard says that you should recognize the additional costs you will incur next year. So anytime they are talking about future, that means we only have to make estimates because there is no way we can know how much we'll pay in future. We would estimate the additional cost we will incur. Okay, so, and in most questions you will find where they can carry forward these leaves, the question will have given you the estimate of what the employee will take next year. The leave they did not take this year, the question will give you the estimate of what they will take. It is the estimate of what they will take. That's our obligation. That is what we owe. So it is the estimate of the additional costs that will be recognized as liability. So you see, non-accumulating, very straightforward. It's just when the event occurs, when the employee takes the leave, we debit staff costs, credit accrued staff costs. But you see this one, since they can carry it forward, that means if they don't take it this year, what we recognize in our books is the estimate of the additional cost that will be recognized as the liability. Now, let me show you a question that will make us think a little bit. Okay, let's look at this particular question. So it says that the Plyman Co. has 100 employees. Each is entitled to 5 working days of paid sick leave for each year, and unused sick leave can be carried forward for 1 year. Sick leave is taken on a LIFO basis, first out of the current year's entitlements, and then out of any balance brought forward. As at 31st December 2008, the average unused entitlement is 2 days per employee. And after that, Plyman Co. expects, based on past experiences, is expected to continue. that 92 employees will take 5 days or less sick leave in 2009. The remaining 8 employees will take an average of 6.5 days each required. State the required accounting for unused sick leave at 31st December 2009. Okay, so this company has 100 employees. Each is entitled to 5 days sick leave. This company expects their staffs at least to be sick every year. So they have allotted sick leave to them. And they now told us that unused sick leave can be carried forward for 1 year. That means it is accumulating. We're not told that sick leave is on LIFO basis. That is, when you carry forward leave, you need to take the current year first. You need to take the current year leave first before you can take the one you are bringing forward from last year. So that is LIFO, lasting, first out. So first out of the current year's entitlement and then out of the balance brought forward. We're now told that at 34 December 2008, the average unused entitlement is 2 days per employee. Okay, that means in this current year, that is at the end of this year, our employees did not use 2 days, at least on the average, 2 days. That is, out of the 5 days we gave them, on the average, they do use 2 days. Of course, they can carry that one forward. When I told that Climaco expects, based on experience, which is expected to continue, that 92 employees will take 5 days or less sick leave in 2009. The remaining employees will take an average of 6.5 days each. So how do we do this? Very straightforward. So at the end of the year, we already know that, okay, they did not take 2 days, which we have to still carry forward. So how much are we going to recognize as liability? How much do we owe? If you say 2 days times 100 employees, you are wrong. Because the standard is that you're supposed to estimate, you would estimate additional costs, okay, that will incur. So what's the additional cost we're incurring? Telling us that 92 employees will take 5 days or less, which means that next year, in 2009, meaning next year, 92 employees will only take their 5 days for 2009. Remember that they give them 5 days every year. And their own basis is LIFO. They must take the one of current year before they take the one they are bringing forward. So now they are saying that 92 employees will not take these 2 days they are carrying forward. They won't take it. That's what this question is telling us. That they will only take their normal 5 days. That means on these 92 employees, we don't have any additional costs. We don't have any additional costs since they will not take those 2 days. So we don't have to book a liability with respect to them since they won't take it. So we won't pay them. When I said the remaining 8 employees will take 6.5 days, which means that these remaining 8, of course, they will take 5 of their normal entitlements, 5 days. They now said they will take extra 1.5, making 6.5. And that 1.5 is the 2 days they did not take last year, they are carrying forward. That means our additional cost as at 2008 is on these 8 employees that will take the extra 1.5 days. That means the leave days that we need to book for, that we need to book a liability for, is 8 employees multiplied by 1.5 days. Because it's only 1.5, it's only 8 employees that will take 6.5 days next year. Meaning they will take their 5 normal days next year and 1.5 days from their 2 days they did not use in this year. So as far as 2008 is concerned, the estimate of additional cost is on these 8 employees on that 1.5 days they will take, which is 12 days. And that's the answer. So this question did not give us the how much we pay per day of leave. So if they give us the amount per day of leave, we'll just multiply that by that 12 days. Okay? And that's that for this question. There is also profit share or bonus. This is also a short-term employee.
Sorry, how did we arrive at 1.5?
What did you say?
How did we arrive at 1.5 days? I missed that.
Okay. So we have 6.5 days. 8 employees will take 6.5 days. Remember, each year they are entitled to 5 days. So we're now estimating that next year 8 employees will take 6.5, which means that they will take their normal 5 days. What this 6.5 days means is they will take their normal 5 days and they will take extra 1.5 days from the 2 days they did not take last year. So that's how I got that 1.5 days. So it's only these 8 employees that are taking out of, or that will take out of their unused sick leave, which is the 1.5 days. And that's what this 6.5 signify. The 5 days they have for that year, and the 1.5 days from the unused sick leave. Okay, so as far as this year is concerned, the additional costs from what we can see is only 8 employees times 1.5 times 1.5. That's 12 days. So that's how we got that 1.5 days. Inyama, did I answer your question?
Yes, sir.
No problem. Now, there is also profit share or bonus. It is also a short-term employee benefit. So when we promise our employee bonus or profit share, how do we account for that? The key question is that when do we have an obligation? When do we owe? But it is at that point we need to account for it. So usually we will owe when the entity has met its profit targets, or we are sure, in fact, when they have met their profit targets. We mentioned at the beginning of the year that as soon as we hit $1 billion in profits, we're going to share profits. We're going to share money to everybody at the end of the year. That was what we mentioned at the beginning. So as soon as they meet that profit target, immediately, that means the company has an obligation. That means they have to share profit or they have to pay bonus. So at that date now, we're going to recognize a liability. Then it's like we debit staff cost, we credit accrued staff cost. But in most cases, it might also be at the discretion of management, where they will not attach it to profit targets. They are the one that will decide that, okay, we are giving bonus, we are not giving bonus. So in such instance, it's at the point where they have publicly declared to staffs that we are giving everybody bonus. So at that point, whether they have paid it or not, they have an obligation. In fact, that's what we call constructive obligation. So at that point, we will need to book it. We will need to recognize it in our books. At that point, debit staff costs. We deal with short-term employee benefits. It's very straightforward. Very, very straightforward. The key question we keep asking, when do we owe? So our normal salaries and wages, I hope you can still hear me. Our normal salaries and wages when the employee has worked, that's when we usually owe. So it is at that point that we recognize it in our books. But for others, like short-term absences, that obligation would arise when the event has occurred, if it's a non-accumulating one. If it is an accumulating one, it's the unused part we need to think about that, okay, what's the additional cost on that? That's when we need to calculate how much we are owing. Okay. So I will leave post-employment benefits for next week class. So let's just start and finish post-employment benefits against next week. So do you have any questions so far? Any questions? Okay. So I don't know, maybe during the week I'll schedule a session with you guys, because I really don't understand this particular class. So we need to know whether you are following or whether this timing is not favorable for you. I don't know. But if I want to judge by your response, it's not good enough. So I mean, it's still good now. Today is the 5th week. We still have a long way to go. Not a long way. I mean, we have not really done so much. So we can correct any anomaly. And I can observe a lot here. So this is a virtual class. And with the way you guys are operating, that's not how virtual class work. You have to be involved. You have to be involved. Otherwise, I mean, that means you'll probably be doing something else. You're not listening. You cannot, you have to do it as if I'm looking at you. There's a reason why I put on my video, because it's just for me to still catch your attention, but you guys seems not to be participating. And this exam is only easy for those that have really worked so hard. Otherwise, the exam will be so difficult. And we would find out that we'll have people failing. Not because they are not intelligent, but because they have not actually read so well. That's why people fail. And it's always very painful. So let's look at it and let's help ourselves. We wouldn't want you to pay so much money and you are not getting value for your money. For us, it's painful, because for us, for most of us, we just really enjoy we enjoy to teach you guys. Like me now, I have a YouTube page. My physical class, when I teach them, I record my class. I want as many people as possible to listen to that and learn from it. Meaning we're even ready to teach people for free. But we know people still need one-on-one touches. They want to ask questions, but you people are not asking any question. So that means there's no difference between you and the people that I'm posting my videos to on YouTube for free. There's no difference. That means you're not getting value for your money. So I would expect a change. You cannot continue like this. And I've been hearing the same complaints from other lecturers at this your level, and would want you to change. So hopefully we would see a visible change from next week. So please go and revise your notes. Do that assignment I gave you, that practice questions. Try to do it. And anything you don't understand, you know that you can always reach out to us to ask questions. At any time, we always attend to you. Out of our busy schedule, we'll create time for you. So I'll see you guys next week, Monday. Bye.